This is a market update on the ongoing Bitcoin correction. Over the past 2 weeks, Bitcoin has fallen from roughly $108,000 to below $85,000, and many investors are asking whether this is simply a healthy pullback or the beginning of something more serious. A new research report published this week by New York Digital Investment Group provides one of the clearest explanations yet for the intensity and persistence of the current sell-off. According to Greg Cipollaro, global head of research at New York Digital Investment Group, the decline is not primarily driven by shifting sentiment or macro headlines. Instead, it is the mechanical reversal of the three structural demand engines that powered the entire 2024-2025 rally. First, U.S. spot Bitcoin ETFs. For most of this year, they were the dominant source of new capital entering the market. In November alone, more than $3.55 billion has already flowed out, putting this month on track to become the worst month for redemptions since the product's launch. Second, the digital asset treasury complex, companies that were issuing equity at large premiums to net asset value in order to buy Bitcoin. Those premiums have collapsed, many now trade at discounts, and the structural buying has stopped. In some cases, firms have begun selling Bitcoin or repurchasing their own shares instead. Third, stablecoins. For the first time in months, total stablecoin supply has contracted. Even more dramatically, the algorithmic stablecoin USDE has lost nearly half its circulating supply since the October 10 liquidation event. Cipollaro writes, and I quote, "Given its role in the sell-off, where it fell to 65 cents on Binance, its rapid contraction underscores how aggressively capital has been pulled from the system. In other words, money is not moving to the sidelines inside crypto. It is leaving the ecosystem entirely." These three reversals did not happen in isolation. They were triggered by the roughly $19 billion in futures liquidations that occurred on October 10. That event broke the reflexive upward loop and flipped it into a downward spiral that continues to feed on itself. Large purchases by well-known buyers, MicroStrategy and the government of El Salvador among them, have had almost no visible impact on price. That tells us the selling pressure is structural and overwhelming. Cipollaro is careful to point out that none of the digital asset treasury companies are in financial distress yet. Leverage across the sector remains modest and most structures have flexibility on interest and dividend payments. But the shift from net buyer to potential net seller is undeniable. His conclusion is sobering but balanced. The long-term secular case for Bitcoin, institutional adoption, sovereign interest, programmable neutral money, remains fully intact. Nothing that has happened in the last 6 weeks changes that trajectory. What has changed is the cyclical environment. Quoting directly again, "We've seen this in every major cycle. The story changes, but the mechanics don't. The reflexive loop pushes the market up, and its reversal sets the stage for the next phase of the cycle." His advice to investors is straightforward. Hope for the best, but prepare for the worst. History shows the path ahead is likely to be uneven and emotionally taxing. That concludes this update. If you found this analysis useful, please give the video a like, consider subscribing for regular market updates, and I'll see you in the next one.